everyone, and welcome to another Future-Proof digital event. I'm John Swolz. I will be your co-host and moderator for today. See that Howard has joined us. I will also be joined today by Sylvia Kwan and Meb Faber. For those of you who don't know Howard, he is the general partner at Social Leverage. You may also know him from his podcast, Panic with Friends. I'm delighted to have Howard join us today and can't wait to get into the conversation with him. Sylvia Kwan is the Chief Investment Officer at Elinvest, a technology-enabled financial services company where she's responsible for creating the investment solutions, strategies, portfolios, and proprietary algorithms that drive Elinvest's investment recommendations across both automated digital and customized private wealth services. Those who don't know Meb Faber, although most of you probably do, he's the co-founder and the chief investment officer of Cambria Investment Management. Meb is the manager of Cambria's ETFs and separate accounts. He's the host of the Meb Faber Show podcast and has authored numerous white papers and books. He's a frequent speaker and writer on investment strategies and has been featured in Barron's, the New York Times, and the New Yorker. So a big welcome to Howard, Meb, and Sylvia. Paula, why don't we go ahead and pop up the results from our polling question? And then while we're doing that, why don't we go ahead now and bring Howard in. Howard, we're excited to have you today. With that, Sylvia and Meb will join us in a few minutes. But how you doing today, Howard?
Great.
That's awesome. Excited to have you. So, Howard, I sent you off a bunch of questions earlier this week for you to look at, but I know we wanted to just sort of, keep it kind of light and breezy and get into a conversation. But with your sort of storied history and your storied sort of investment career, I'd love to know, as a successful investor and entrepreneur, what initially attracted you to the alternatives investments and how have they shaped your investment approach over the years?
Well, I went one part of alternative seed stage. So we write $1 to $2 million checks. We're investing out of our fourth fund. Panelists can't vote. I'm getting polls sent up. So, how it worked. I got lucky. Listen, internet came along in '99. It seemed like the greatest thing. Obviously, we had the bubble, and it wasn't the internet that really became consumerized. I was lucky that consumer web. I wasn't so old as to not be able to enjoy it. The consumer internet really exploded in 05, 06 with YouTube, with the apps, right? YouTube, LinkedIn, Facebook, Twitter, and obviously the cloud. So, if you had fingers and were typing and were connected to the internet, it had to change your life. And it did. And so anything that you thought could be done. And so as a creative person, luckily I was curious enough to be surfing the web. And as an investing background, it just became obvious to me that I should be investing in and creating companies on the internet. And it's just, everything. It wasn't just an overnight success. It was just everything I had done from investing and media culminated in like YouTube appearing, and I was just fascinated by that. So part of that is you have to be curious and you have to be fascinated, and you can't just fake it. The internet allowed you to just reach millions of people, and now tens and hundreds of millions of people.
Were you into like technology and computers and that stuff before, or it just was a curiosity that got you there?
No, I remember my dad bought me like an Apple Macintosh probably in the 80s or in the 70s. The 80s. And it just sat there. Like it just didn't seem intuitive to me with discs, and the mouse was intuitive and the keyboard was intuitive, but the screen sucked and was slow, and I just didn't get it. I was like a comedian I was into media and comedy. So that was interactive. So right. The computer was slow. Like it made no sense to me because it was a box that slowed down my life. Today it speeds up everything, but back then, it slowed your life down because it was clunky. So no, not a geek. And so the first internet boom didn't interest me either because it was a DOS-based world. But obviously the browser kind of changed things. It allowed you to just visualize things and poke around, and the link-based web, which was Web 1. Web 2 was more about the social web, which really fascinated me. And so I'm not a tech person. I do think it helps. If you want to start a company and it involves the internet, I do think Web 2 mistakes on me for sure is it helps to be an engineer or some kind of product person or design person. I think this new era will be more about business people, because AI will be more about a lot of this stuff can be built without, you don't have to build for Android, you don't have to build for Apple, you don't have to build for 9 different things. You can build for the web. So I'm very excited about it, but I think it's helped to have been an engineer and to think like an engineer. And I think it always will be an edge, but I think that edge is broadening in the sense that you don't have to be an engineer anymore.
Right. So with that, as you talk about the kind of current environment, right, alternative investments can cover a wide range of asset classes and strategies. Which alternative investments or what areas of the market do you find promising in this current environment, and why?
I don't think there's anything that, I do think it's like mixed. I think like just an internet business is not enough anymore. I think you live in a world where you have 8-year-olds and 80-year-olds using the internet, and they have a vast different amount of life experiences. So I think mixed media, where you're combining physical and digital worlds and things that attach that, whether it's gambling or trading, et cetera. But I don't think it's as simple as just, I want to build an internet business, because we now live in a world where these centralized dominant companies control the pipes, much like they did in cable and telephone.
Can you expand on that a little bit?
Well, I just think if you had told me that it was just going to be Apple and Google that basically control mobile, that would have been a hard bet. Or that YouTube would be the dominant one only, video platform, because for all intents and purposes they are. It seemed like we're supposed to have an open internet, right? And that's why crypto has so many people excited. But in the end, we have gatekeepers. As open as the internet is, if you're not building if Apple says your app, like crypto, if your Apple says your app doesn't cut it, you're not in the Apple store. Like, what business are you in? And that is why there is this slowdown. Right. AI has created this new buzz, but it doesn't change the fact that we have gatekeepers and there is going to be a slower market. So I think anything is still cool, but you have to factor in 5% interest rates. You have to factor in that there's gatekeepers. So the cost of acquiring a customer goes up. The cost of doing business goes up. It's much like in the old days when you had to call US West and spend 10 grand to get a phone box in here. And then you had to spend 10 grand on a computer, and then you had to buy a fax machine. This new internet that we were so marveling over has now gotten expensive because Apple and Google give you a thumbs up and thumbs down whether you're accepted. So there is new risks, and then you have higher interest rates. So I think anything's possible. That's the good news. The bad news is the world has shrunk. China's walled off. Everybody's kind of walled off. There's a war, higher interest rates. And the fact is anybody can build a product. So you have more competition. You have more expensive to market that new product that you invent, higher cost of capital, and a shrinking universe of customers as people shrink down their countries.
So with that, then, if you were to look maybe outside of internet and things like that, do you look at things now like opportunities in, say, private credit? Would you look at things like renewables? Are you betting heavily on blockchain or artificial intelligence? Like, if you had to move away from the internet to some extent, what areas might you begin to sort of sniff around or poke your nose into?
For me personally, I'm 58, so everything's about my prostate and longevity, saving what's left. And I'm wearing 2 times magnifier. I'm basically held together by like a string at this point. So I think anything that as you get older, and it's funny, but it's also true, I think it's very hard to change tricks, right? You get used to having a trick that works, but now I'm in this phase of life where my kids don't live with me. I have to look over their shoulder. I used to be able to look over their shoulder to see what they're doing. Now I don't know. Now it's just me. So in a world where it's just me and I'm an empty nester and my wife has different interests than me, I have to trust my own instincts. And more than talking to, I have my partners, whatever. But so I'm more involved in things that I love because I trust the things that I love. So I'm projecting, golf, watches, fitness, luxury, travel, entertainment, media. So I'm still a wide array of interests, but it's much different than when I started in the business. And I really have to have a pattern. Now that I'm 58 and my years are numbered, meaning they may not be numbered, but I'm saying mathematically they're numbered and I'm getting older, is anything I do is like, I got to commit 10 years to that. And I don't think enough people think about that. And I wish I had, but if you're going to invest in a startup, it's 10 years of your life.
Right.
So anything I invest in today I'm going to be 68 when that company, if it's successful, will be really at scale successful, if not 70. So what will I feel like? Is it worth doing?
Well, you'll have 4-time magnifying glasses then.
Yeah, once you're down that rabbit hole, for sure, it'll look like Mr. Magoo when we do this next year. So you have to start thinking about all those decisions. When you're 30, you're not thinking about 10 years. When you're 58, you have to think about 10 years.
So Howard, before we bring Meb in here and let you get a break for a quick second, if I'm a financial advisor and I'm thinking about alternative investments for my clients, should I start to talk to them about a 10-year horizon? Should I be talking to them about just getting access into some sort of vehicle like an ETF or an open fund? Sort of how would you, if you were an advisor, be talking to your clients to set the right mindset for these types of alternative investments?
Boy, it's a good question because it's just, it's obviously you got the BlackRocks and certain large firms that can offer alternatives. My worry about like what I do is capacity constraints. So who is offering this product? Like social leverage, the best funds are generally seed funds are generally under 100 million, 150 million. So can't be open to everybody.
Right.
So the first thing is, yes, if you're going to invest in something like that social leverage does, give yourself 8 to 10 years. And then secondly, try not to cherry, they say don't market time and everybody does it. But the idea is you can't pick the crop. Like the idea that you're going to pick the right crop for your 8 years is maybe you get lucky, but you have to consider doing it for 2 or 3 cycles so that you're not timing the business cycle. So I recommend if you're going to commit to something like this, you commit to like 2 or 3 funds or 6 to 7 years of investing so to make sure that you get the whole cycle.
Yeah, and that's not something you typically see from a lot of investors. But with that, Howard, we're going to let you get a rest right now. If you want to turn your camera off and go on mute and relax for a few moments, you can do. We'll bring you back for questions. Why don't we go ahead, Meb, why don't you turn your camera on and come in and join us real quickly. I'd love to start to pick your brain a little bit here on getting access to those products. As Howard said, you have to sort of think about it a little bit differently. But Meb, before we get into that, I'd love to know, as a co-founder, a CIO, you have extensive experience in alternative investing. Sort of what initially sparked your interest in this space and what kind of keeps your attention today?
Well, when you talk about alts, you got to be clear with the verbiage. I think the vast majority of American investors, professional alike, are mainly in U.S. stocks and bonds. And so really anything outside of that, even basic buy and hold, what we would call beta exposures like REITs, commodities, foreign stocks, are woefully underallocated to. Don't even start foreign bonds, which is actually the largest asset class in the world. No one invests in. If you're watching this, you can see in my background, on my dad's side, we had a farmland background. Kansas and Nebraska has been a fantastic asset class. One of the few ones, if you look at this sort of global long only market portfolio that's really hard to allocate to. And then it's just kind of how far do you go out on the spectrum of what you mean when you say alts. It could be everything from, style and strategies to pretty hard to allocate to asset classes. But many of those are getting opened up either through public vehicles like ETFs. I mean, we manage a dozen ETFs, and then many of which people would consider to be alt-like. And then, but also even through private vehicles. I mean, pretty much today through an app, you can invest in wine, whiskey, farmland, collectibles, startups like Howard talked about. Howard actually put me in my first angel investment. We made some money together. This was 10 years ago almost. So his time horizon was interesting, but then he never offered me any more. So I'm not really sure what happened. But we mostly exist in the public space. There's probably never been a better time to be an investor. That having been said, if you follow me on Twitter, you'll also notice that I went down a rabbit hole on Instagram a couple weeks ago where I posted screenshots of, I don't know, it's like 30 and counting. What would I consider to be like fairly predatory alt sort of products, promising 30, 40, 50% returns annually, not total. And many of those I think are probably going to be pretty slimy. So like with anything, the further you move away from Vanguard, there's certainly more potential for outperformance, but also potential for getting burned too.
So, Meb, with that in mind, then that there is this sort of predatory, exposure that's out there for folks. How do you sort of recommend when you're talking to advisors how they think about looking at vehicles that are in the public markets versus private markets versus something they may be seeing on Instagram?
I think, and this is basic, but you better do your own due diligence. I mean, so many people, they read the headline, and I love Vanguard, but I like to pick on them too. If you look at their large dividend ETF, VIG, it's like $60 billion today. And many investors, I think, if you see the headline, the name of that fund, you would expect that that fund, would represent a certain style and idea and concept. But then you look at the actual holdings, when you're a $60 billion fund and look at the underlying fundamental metrics, it's probably not doing what most advisors who buy it on the name only think it's going to do. And so many people, they'll see a fund, whether it's thematic or a style strategy, be a value ETF, right? Say, sweet, I accept this value trade. I'm ready. I heard Cliff talking about it on Bloomberg. I'm buying value. And then you look into what it owns, and it's basically the S&P, right? And at a much higher fee. So I think this is like the grocery store problem, where if you're going shopping for cereal, there's hundreds of brands, and with ETFs and public funds, there's over, 10,000. And so I think the struggle for many people is this education gap, and really, how many people actually read a prospectus? I don't know, 0.1%, maybe.
That's probably even high to some extent.
So, I think the good news is it's never been a better time to be an investor. There's limitless choice, but also limitless, ability to get in trouble too, which is one of the reasons you see career risk is what drives a lot of consensus allocations, like a very home biased, buy and hold market cap weighted sort of 60-40 allocation, which, most people can feel safe and comfy in that, despite the fact it's probably a very suboptimal way to invest.
Yeah, absolutely. You hear more and more about that. So, Meb, we talked a little bit about time horizon when we were chatting with Howard here. Given that, market dynamics are ever changing, how do you suggest to financial advisors assess potential risks? Obviously, knowing that these may be long-term investments, how do you sort of weigh what's going on in the market versus what long-term, expectations might be, and then kind of communicate that to clients?
We like to do a lot of polls on Twitter where we ask people questions, and are often frustrated with the answers. But one such question is, when you buy a fund, do you establish criteria for why you're buying it and when and how you're going to sell it? And it's like 90% of people say no. And these are professional investors. Like, you can't follow me on Twitter and be a meme stalker, because my stuff is quanty and boring and nerdy. And so the vast majority of the sample size is actually professionals. And so it's really frustrating. The vast majority of people, they may spend a little bit of time on the buy decision, and then they just wing it. And, we often say, look, you should pull out a note card and write 4 things down, 4 questions. Why did I buy this fund? 2, how long do I plan on holding it? 3, will I rebalance this? And if so, how, when, and, in what manner? And lastly, like when I want to sell this fund, what's the criteria I'll use to sell it? And I think those 4 questions already would put you ahead of 99% of people. And it applies to like startup investing. It applies to farms. It applies to a stock ETF. Not just when it goes wrong, which is what most people think in their head. I'm going to buy this investment. Oh, it just went down. What am I going to do? I'm panicking. I have a lot of emotions. But also when it goes right. There's times you have an investment and it doubles and you're like, oh my God, amazing. I'm thinking about vacationing in Cancun, buying a new apartment, whatever it may be. But as we know, every investment that was a 10 bagger or 50 bagger or 100 bagger at one point was a double. And so, often in many cases, the big mistake would be selling something too early. So I think thinking through it, this applies as a framework to every sort of alt. No matter what it is. And then certainly being mindful of other things like fees and expenses, and the big one, taxes, which people only think about really once a year, but is incredibly impactful.
So, Meb, you've just gone through sort of a whole bunch of pitfalls and sort of different things that people should be thinking about. For the sake of this getting, too far down the risk side, what are the unique advantages, though, of alternative investments, and why should, investors be, opening up their portfolios and changing that 60-40 to maybe something that's a 70-30 with a 10% allocation to alts or whatever it might be. But, what are those unique opportunities that alts provide as well?
I mean, there's two. It's either increased return or diversification, and zigging when other things zag. I mean, a lot of people listening to this have probably a pretty fresh memory of last year where a traditional portfolio got waxed, probably down 20%. And so you have things like moving away from market cap weighting in the US. We think this is one of the biggest opportunities in history to move towards value investments and away from market cap weighted S&P style investments, which should do probably, we think, low single digits over the next decade. Value is probably in the top 5 or 10% of history as far as the spread versus S&P. So that's like a return enhancing. Although traditionally during long bear markets, things like value traditionally lose less than something like a market cap weighted index over the course of the long period. Moving into things like foreign investments is a no-brainer. We've talked a lot about this. We have an old post called The Case for Global Investing. That can work both. It could be higher returns due to the fact that foreign and emerging are much cheaper, broadly speaking, than the US is, but also the diversification benefits of being in foreign equities that zig and zag when the US performs great. I mean, we did a post on Twitter yesterday where we said this is one of the 4 times in history where the S&P on a rolling 10-year basis has had a Sharpe ratio above 1. It was the roaring 1920s, the nifty 50s, internet bubble, which is my favorite, and whatever we call this most recent one, the meme stock kind of crazy COVID period. And so moving into foreign is probably a no-brainer as well. And then you kind of get weirder and more differentiated. We think real assets are important, REITs and commodities, particularly in times of inflation, unexpected inflation. And then the big one that we're probably the most non-consensus on that no one really likes is trend following as a large part. We're probably the biggest outlier there as far as allocators in the country, with allocating to a traditional allocation of 50% in trend, which right now is actually in a lot of global equities, some sectors like tech, and a sprinkling of precious metals too.
Gotcha. So it sounds like from your perspective, you want to certainly be diversified. You want to be spread out across some different asset classes there, and really sort of kind of reduces risk as much as possible as you can, which makes a ton of sense. The last question that I kind of have for you here, Meb, before we bring Sylvia in, is I wanted to talk a little bit as you think about, being a financial advisor and you're using these products. All of a sudden, there's a huge demand to get into the wealth management space and open up these markets. Why have these markets turn their attention to financial advisors? And should they be nervous that these markets are now opening up to them and being so easy to access when they've sort of been traditionally held for high net worth investors only or institutional investors only, and now all of a sudden they are available to retail investors? Is there a risk in that? And should advisors be weary that they're coming after their clients?
Man, there's a lot wrapped up in there.
Yes,
I
for
think,
sure.
I personally think that advisors have one of the best future-proof, not to use a phrase, but that won't get disrupted style careers of almost anyone. And largely, it's not the asset management side. To be clear, I think they do a good job of packaging investments, but really, to me, it's more the emotional value added side on like almost like a money coach, I think is really important. And I don't think that goes away. And I think even in times of opening up all the potential opportunities, and look, I've been a long-term proponent of a DMV style accredited investor test. You take an online test, you go through whatever, you pass it, God bless you, you should be able to nuke your money, because already, let's be honest, you can trade Forex, you can trade day options, you can trade cryptocurrencies to your heart content. You can go to the casino. You can go to the horse track. There's limitless ways to lose your money. We had a great quote on our Twitter feed the other day from Galbraith that said, "It's the sovereign privilege of a free citizen to lose his money precisely as he pleases." So I'm a big supporter of that. Now, within that, of course, I think it's important to have rules and regulations we consistently flag what we consider to be frauds on Twitter. I don't like being the bad guy, but we've identified a few that have been multi-$100 million frauds. It would have been much more economically viable for me to be a whistleblower than to simply mention them on Twitter. But I think it gives the rest of us a bad name in the industry. So try to be open and transparent. But I mean, I think at the end of the day, the big word that we all care about is fiduciary. And so having an advisor who they may make honest mistakes, and they may really believe in some of the concepts they're preaching, but on average, I think most are genuine and thoughtful people. And it's a question of, did you do your due diligence, and did you really put in the work to be a fiduciary and effort to actually read a prospectus or see what these funds and strategies are doing, rather than just click allocate.
Yeah, it does seem like technology, well, one, it is making the products more available. It does seem like it's also making it almost too easy to sort of skip that due diligence process, because you can go in, click around, build yourself a portfolio. Now you've got an alt allocation that you can white label and send to your clients and get out there. So I do think, there is that fine line that you need to be aware of as an advisor, as you're starting to bring clients into this new asset class and start to make it part of your asset allocation. So Meb, we'll give you a few-minute break as well here while we go ahead and bring Sylvia in. We're going to talk a little bit now from the idea as a financial advisor and sort of how she thinks about building these portfolios. Howard, you got something to say?
I do. Sorry, Sylvia.
Awesome.
I've got to. Something just came up. My house has got a leak. I apologize. I'm sorry to hop off here.
No worries. We've got Howard with a leak in his house. That's all right. We'll finish up with Sylvia, and then we'll do our live Q&A with Ned and Sylvia. Best of luck, Howard, and hopefully the plumber doesn't take you for a
I'll come back in if I can here. Sorry.
Yeah, absolutely. We'd love to have you back on for the live Q&A.
Sylvia, nothing personal. And Meb,
No worries.
I emailed you separately, and I like your glove.
Good luck, Howard.
Okay, thanks.
All right, Sylvia. So, we've talked a lot about some of the risks, some of the opportunities, things that, Howard sees in the market where he's thinking, but you're actually building asset allocations for clients at this time. So, my first question for you is sort of, as someone that's using alts and has, if I was a financial advisor, what would be the first thing that I need to be asking myself as I start to toe dip into alternative investments?
Yeah, I think that the first thing for an advisor to ask is really about, hey, is adding alternatives to my practice the right thing to do for my clients? As Meb mentioned, we're all fiduciaries here. So you need to think about, is it in their best interest? And just because everyone is jumping in and it's, very popular now, it actually doesn't mean it's right for your practice. And so I think, I would encourage advisors to really reflect on the why. Why are you adding alternatives to your practice? And certainly for many advisors like Ellevest, and I'm sure like Meb and Howard, there's multiple reasons. We believe they can add real diversification against stocks and bonds. They can help, lower overall portfolio risk, generate income, enhance returns, and so on. And one that I might add that we haven't mentioned yet is the kinds of alternatives that we offer also have usually some kind of positive environmental or social impact, which is very important to our clients, which is yet another reason there's a much more direct ability to make a positive impact through alternatives versus, say, public really depending on the kind of practice you have and who your clients are, what their demographics are, and that can really help you decide, whether alternatives can be a big part of your practice or not.
Yeah, absolutely. So as we think about that, right, because they are becoming cheaper and tech enabled, in your mind, is this something that should be now in every client's account, or is this still set up for more of your high net worth clients that can, diversify their portfolio? Sort of, where is that line between like, yes, because it's, democratized, everyone should have it, versus yes, this is right and not right for some?
Yeah, I think it really depends on the why for every client. Yes, it's great to see alternatives, kind of moving down the chain and becoming more accessible to retail, but just because they're cheaper and they're accessible doesn't mean that everyone should jump in. Not all alternatives are created equal. And so you need to think about, for example, hey, if the reason why you want to add alternatives is really to add that, real true diversification that is not correlated with stocks and bonds, then you need to look at, hey, what is available that is actually going to give me that diversification. And so, a lot of the most, I would say, diversifying alternatives are not liquid. So you need to consider the liquidity issue. And of course, there are alternatives that are fully liquid, but they may not offer kind of the diversification that you're looking for. So you really need to sort of understand, what's the objective of the client? What are the constraints of each client to determine whether alternatives is actually value add for that particular client?
Gotcha. Yeah. So that makes a lot of sense, right? Is it a value add? So if we get to the point now where we believe it is a value add for the client, and this is something that they need to put into their asset allocation, it's come up already where we've talked about a 60-40. We've talked about potentially, a 70-30-10. As you think about that mix, sort of where does that allocation from alts come from? So do you take it from your stocks? Do you take it from your bonds? Do you take it equally? Sort of how should advisors be thinking about where that allocation should come from and what they might be trimming back to make it?
So we at Ellevest, we take a goals-based approach to asset allocation. And so when we think about asset allocation, we think about, what is the role that each asset has in that portfolio. So if you think about equities, for example, obviously, they're used for long-term growth. It's for capital appreciation, maybe inflation protection as well. Purpose of fixed income is generally capital preservation, diversification, income generation, stability, that kind of thing, right? And so when you start to introduce alternatives, again, you want to think about what is the objective of allocating to alternatives. If a client, for example, needs their portfolio to generate income, and let's say you add income generating alternatives, then that might mean taking that allocation portion from the fixed income, traditional fixed income allocation. And of course, vice versa. If you're adding private equity or venture, then that might mean taking from the equity allocation. And so I think it's less important to look about, because there's all these different ways to present an asset allocation using alternatives, right? You can do whatever 60-20-20 or 70-20-10 or whatever. It kind of doesn't really, we've seen advisors also, have, continue with the 60-40, but within the 60, it's, public equity and private equity. And so there's just different ways to present it. Probably doesn't really matter how it looks. What really matters, I think, is what is the role of that asset class in the portfolio, and what purpose does that allocation have to achieve the client's financial goals and objectives?
Yeah, absolutely. Makes a ton of sense. And it certainly doesn't make it an easy answer either, as to be like, okay, well, now I know, like tomorrow I can come into my office and say like, all right, we're trimming down the equity position for this. Does sound like there's much more homework needed from an advisor to really understand what the product is. So I have two questions for you here that I think would really help an advisor audience. So one, if I'm now sort of thinking, okay, I understand that I need to look at where it's going to fit in my portfolio and where that allocation has come from. Do you find that there are areas of the alts market that are just easier to access and make more sense for a first-time investor, as opposed to maybe someone who's had 10, 15 years of experience? Like, I'm a first-time investor or a first-time advisor using alternative investments. Is there an area you might recommend that I look at first?
Yeah, I think so. Alternatives, they really, today at least, they really span across the entire risk spectrum, from alternatives, which I would consider pretty low risk, to ones that are very, very, very high risk. So if you are starting out as an advisor who are new to adding alternatives, I would probably start kind of more on the lower half of that risk spectrum. Both with strategies that are easy to understand, because as you know, you got to explain these to clients. And so the easier the strategy is, the more simplified it is, and easier to explain to clients so that they actually get it, the better. So an example of that might be something like renewable energy assets. So I'm talking about funds, for example, that acquire, solar and wind assets, and they've got off-takers who purchase that electricity, and it pays a very steady dividend. So imagine if you're talking about this to a client, it's kind of similar to a utility, where the risk is pretty low. You get the dividends that are pretty consistent. It's kind of easy to explain how the electricity is generated and how that's purchased. And so it's a pretty easy concept for clients to grasp. And it's also fairly kind of low on the risk spectrum. And so it's not something that, you're going to find yourself, a year from now explaining kind of, hey, what happened, blew up here, right? Because we never want to be in that kind of situation. Another example might be real estate, because most people understand how real estate works. Might be areas that are kind of more recession resilient, like, workforce housing, multifamily housing, or like triple net lease retail and essential services, things like that. So I would kind of start in areas that are kind of lower risk, maybe that generate some kind of income, and that are something that is easy to digest for your clients.
Absolutely makes a ton of sense, right? People like to invest in things they understand, both from an advisor perspective and a client's perspective. So I have one more question for Sylvia, but I do want to encourage our audience, because after that, we're going to bring Meb back in, and hopefully Howard got his leak fixed and he can come back in and join us as well. So please go ahead and get your questions in. Sylvia and Meb are super knowledgeable here. And I saw through the poll results that most of our folks were very familiar with alternative investments. So let's ask some good questions of these guys and let's put them to the test. So Sylvia, the last thing I want to ask you here is, as you think about being an advisor, we know that every client loves to buy and hold, but we also know that, like, I think it's 18 months or something like that is the typical holding period for the average investor. As an advisor, how do you talk to clients about, hey, this is a type of investment that should have a 5, 10, 15-year time horizon, when we know most of them are only going to hold stuff for 18 months potentially?
That's a great question, John. And so we work really hard to really kind of train our clients to think long-term. And that's kind of where that whole goals-based comes about, because if you've got a long horizon, and when I say long, it's got to be at least 10 years, you have to have that expectation that, hey, this investment, in order for it to play out and to maximize the chance of success, to allow the manager to have the time to implement it in the way that, you're paying them to do, that means it's got to have a long horizon. And so I think it's really important to set that expectation up front. And that's, I think where things sometimes get out of whack, I should say, is when you have alternatives that are kind of semi-liquid. I'm talking about things like interval funds or funds that have the opportunity, I would say, for redemption. And that's where I think it gets tricky. It's not to say that they're necessarily bad, but often there is a mismatch between the frequency of the redemption opportunity and the horizon of the underlying asset. And I always like to say, kind of, they work until they don't. And I never want to be on that side, kind of explain to a client. And so I think it gives a little bit of a potentially I don't want to say a false promise, is a little bit too strong, but it leads an investor to believe that they can kind of withdraw, at some point, whether it's a quarterly basis or monthly basis. And we've seen, certainly situations where that has not worked out well. And so our preference is really to set the expectation for the clients, like, okay, this part of your portfolio, you're in it for the long term. It's got to be a 10-year hold. Yes, we're going to keep all of this other stuff very, very liquid for you, but, really get that mindset in for the client.
All right. Well, Sylvia, I appreciate your time and going through some of these sort of questions for the advisor. Why don't we bring Meb back in here, and we'll go ahead and get to some of the Q&A from the audience. So again, don't hesitate to submit your questions. So the first one is, and we'll start with you, Meb, to give an answer. Then Sylvia, you can jump in. But what are the main alternative asset classes one may consider for investors with more than 10 years of a time horizon, moderate to aggressive risk tolerance for accumulation purpose? So I know obviously we don't want to make recommendations necessarily, Meb, but again, if you had more than 10 years, were moderate to aggressive, and you were looking to accumulate some assets, what might you consider in the alternative space?
So we wrote a couple blogs during the pandemic, one of which has now become a white paper, but one was called the Get Rich Portfolio and one was called the Stay Rich Portfolio. And they were kind of fun, conceptual, philosophical ideas and formats for thinking about asset allocation. I think for those, the two biggest things we think about on a traditional portfolio that are easily and exchange traded are certainly tilting towards value, which also leads you abroad. And then second, towards trend. And again, these are more meant to be diversifiers, return enhancing, but it's not going to take you from 7% to 20%. You know, if you're investing for your endowment, your kids, some charity, you want to be doing closer to what Howard is doing, I think. And we wrote another blog post called "The Journey to 100x," which was a very transparent and honest overview of my angel investing journey for the past decade. And, you know, I'm up over 300 angel investments at this point, and probably closer to 400. And it has a lot of benefits, not just on the pure numbers of return side. And we go into a lot of detail there. I think it helps you see around the corner a little bit on public markets. I think it gives you ideas for your personal and professional life. It's optimistic and fun compared to public markets, which are often filled with noise and pessimistic and depressing when you turn on CNBC and just hear everyone shouting on Twitter. You know, I think a lot of people mentally bucket them separately when they think of, all right, I want to get rich or really, you know, try to shoot for the moon on 20% returns, or I just kind of want to make this asset allocation safer and more sustainable. I think those are somewhat two different questions, but I think a lot of it comes down to philosophy too. And we've just kind of finished one of the worst periods ever for a thoughtfully diversified global allocation portfolio. S&P's beaten everything, you know, for the past 10, 15 years, right? So I think there's kind of fork in the road on both the ways you could go there, both of which could be, you know, interesting for depending on your goals.
Absolutely. So Sylvia, you just put yourself, you know, think of a client coming in with those requests that, hey, I'm looking to make a whole bunch of money. I got a long-term time horizon, happy to be aggressive. Where and how are you steering them into the alternatives market?
Yeah, so if we're kind of just thinking about sort of the alternatives and not the public markets, I, you know, certainly think of alternatives sort of on the higher end of the risk spectrum, given the long horizon, as well as the sort of more aggressive tolerance for risk. So that would, you know, include things like venture, private equity, things like that. But I think instead of saying, oh, you know, venture innovation, yes, potential for very high returns, as well as a lot of risk, instead of like thinking about it as like, oh, I'm going to put everything in there. Like I would again think about it as of how can I build a diversified allocation to alternatives that includes venture, might include private equity, it might even include, for example, you know, development of real estate. So looking at sort of all the underlying risk and return characteristics and making sure that they are from different sources. And so you don't run into, you know, what happened to like the 60-40 portfolio in 2022, but you have things even within the alternatives allocation that move differently from each other.
Absolutely. So we've got about 4 minutes left. We have another question that's come in here. Again, we'll go to you, Meb, for maybe a quick 2-minute answer here. Will higher interest rates on the cost of capital reduce the potential returns in alternative investments?
You know, everything gets measured against the risk-free rate as well as for inflation, which tend to kind of go up and down together. And a lot of people over the past decade are saying, well, managed futures and a lot of derivative-based strategies, you're not getting the same collateral income you used to get when you had interest rates at 5-10%, which is true, but it's also true for everything. And so one of the things we do think about if inflation is stickier, I have no idea, nor does anyone else, but if it was higher than zero, which is where it's been for a long time, you know, what does that look like in implications? And certainly part of it is looking at past decades where, you know, inflation has been more sustainable. But one of the biggest conversations I've had with a lot of advisors over the past 6 months have been, we're just chilling out in T-bills. You know, I'm kind of happy to be 5% and we're not doing anything right now. And we're just kind of cruising, which seems to be a pretty commonly held sentiment, which, you know, people haven't had for a long time. I mean, 0% has been the standard for many years. And so I think people feel fat and happy and warm and cozy having these yields, which they just haven't had access to in a long time.
So Sylvia, before you answer that, we have another question that just came in that's really interesting that I think might be great for you. Again, if maybe you could give your 2-minute answer, and then we'll give Meb an answer to a minute to come on top as well. My practice has struggled at times with clients who don't appreciate the diversification element alts provide, especially when the performance lags the S&P or even bonds lately? How do I convincingly defend the benefit of staying invested in these strategies during these times? So Sylvia, we'll start with you, and then Meb will give you a minute to finish up.
Yeah, that's a great question, Cole. And it's something that, when we started, ad nauseum talking about why you want to have alternatives in the portfolio, why it adds diversification. And I think one thing is if the clients understand the investment strategy and what those sources of risk and return come from, they understand the diversification. But what really convinced our clients finally, even though they're like, yes, I get it in theory, was obviously 2022. And for that, 2022 was a silver lining for us because, all clients looked at their statements, they saw their equities are down, their bonds were down, and oh my God, all the alternatives are doing really well. Okay. Oh, I understand what you mean now. I totally get it. And so sometimes, in theory, you can talk, until you're blue in the face. Clients will understand it, demonstrating, those, why it's uncorrelated and why it can still perform even in markets is down is a great start. But honestly, it's not until they actually experience it and see the power of the diversification on their statement, then they're 100% convinced. And now they're like, oh, all of my portfolio should be alternatives. And then you got to like, no.
Yeah. Then you get the other problem. Meb, any thoughts to finish out that question?
I have a lot of thoughts, man. We need 2 hours for this. I think we talked to a lot of investors over the years, and I think this applies to any asset class as well as strategies like alts. But people used to come up to me and ask me and say, Meb, I bought your fund. It's not doing great. It's been 6 months. I'm going to give you like a few more months because I like you. How long should I hold this?
Right.
What's a reasonable time horizon? I used to say 10 years and now I say 20, and they laugh and they think I'm joking. And I say, I'm serious. And then you look at sort of the agony and ecstasy of even just the S&P over the decades, where it underperforms bonds for decades, and having to live through that. If you go to other countries and ask them how great it's been to be a buy and hold investor, they would scratch their head and say, what are you talking about? Buy and hold investing doesn't work. So I think, being thoughtful about how you build this, not just with alts, but with bonds and US stocks too, and being honest about it is more important than anything. And then just chill out and go to the beach, stop spending so much time on it. Once you allocate, just kind of move on and check back in when we do this again in 2033, excuse me. It's hard to say in 10 years from now.
Absolutely. Well, we'll have to set this on the calendar for 10 years now. I want to thank Sylvia and Meb for their time today. Certainly want to thank Howard. Hopefully things are okay for him back at his house there and he's not getting flooded out. Obviously, a very big thank you to everyone that joined us this afternoon. We appreciate you taking 50 minutes of your day to spend that with us. So we're going to take a break from the Future Proof Digital series for the summer. So this was our sort of last day of school here, and we'll be back on October 18th, where we'll be talking about M&A and all the activity that's going on in the wealth management space there. But don't worry, if you're going to miss me or any of the amazing guests that I've had here so far in the first half of 2023, you can join us this September 10th through the 13th in Huntington Beach at Future Proof. You're going to want to go ahead and book your ticket before the 15th of August, where you'll be eligible to join our Breakthrough Meetings platform. Breakthrough will facilitate more than 10,000 double opt-in 15-minute meetings on site at Future Proof. It's the best way to meet everyone you want to meet at Future Proof in 2023. The best part is that if you're an advisor, you can qualify for a free pass and a potential travel stipend. So check out futureproof.advisorcircle.com. Explore the different ticket options, find out the one that's right for you, and we'll see you in Huntington Beach this September 10th through the 13th. But before then, everybody have a great day. And again, a big thank you to Meb, Sylvia, and Howard for joining us today. Have a great day, everyone.